Yeah, was scary for sure. I think it'll knock out those mom and pop people that are buying gold and silver right now. Um, and then I think that sets the stage for silver to 75, gold to 5,000 or 6,000. And by the end of the year, I'm pretty confident in calling $100 silver by the end of 26.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a timely and important discussion lined up. We're fortunate to have with us Gary Savage, president of the Smart Money Tracker. Gary, it's a privilege to have you back on Metals and Miners. Welcome to the show.
Well, thanks for the invite again.
Yeah. So, Gary, you've been analyzing markets through your unique technical analysis lens for decades. We're currently sitting in the next great precious metals bull cycle, where you've stated that it would be a piece of cake for gold and silver to reach very lofty numbers when it's all said and done. However, with that said, there is tremendous volatility along the way, which creates confusion, doubt, and worry in many investors. What do you hope for those tuning into our discussion right now that they'll walk away with after listening to our discussion?
Well, right now, I think we're probably moving into the declining phase of the intermediate cycle in metals. And I think we're about to enter that same declining phase in stocks like the S&P and the NASDAQ as well. So most everything has been rallying pretty aggressively for months. And it's probably just time for a rest, a cooling off period. Sentiment's got exceptionally bullish in almost everything except the dollar. So I'm of the opinion that we probably did start the declining phase in metals today, and I think stocks are not going to be far behind, and probably the rest of the many of the rest of the markets as well.
All right. So basically just setting expectations for everybody that for a period of time, sentiment and price movements, they need to calm down a little bit moving forward before maybe the next up phase begins.
Correct.
Okay. All right. So since gold reached about 4,200 and silver reached about 50, there's been a tremendous amount of volatility in both precious metals. Before that, they seem to just be on a march higher relentlessly every day. Today, specifically, was very strong volatility to the downside. What do you believe is the reason for this sudden strong volatility that we've been seeing at these specific levels?
Well, part of the reason is the entire metal sector has just gotten sentiment has gotten wildly bullish, and price has gotten stretched obscenely far above the long-term moving averages, the 200-day moving average, and much worse above the 200-week moving average. Now, if I thought we were going into the final 8 months of the bull market where we're getting ready to go parabolic and the quote unquote bubble phase, then I could ignore that, but I think it's too early for that. So I think we got to continue to climb the wall of worry, and that means that you're going to have some corrections along the way. And as the bull market progresses, those corrections are going to get more volatile, and we saw that today in the metals. Big volatile move in gold, extremely big volatile move in silver, and I warn people on Twitter to be kind of wary of this breakout in silver, the breakout above $50. It was coming very late in a very mature intermediate rally, and one of the rules is that breakouts that occur late in cycles generally don't produce sustained moves. If you can get a breakout that occurs early in an intermediate cycle, that you want to buy aggressively because that has a lot of room to run. A breakout that comes 25 20 or 25 weeks into an intermediate cycle, I'm usually very wary of those kind of breakouts. It's just too late in the cycle. Sentiment's too bullish, and usually what happens is smart money will sell into that breakout, especially if it's 20 weeks or 25 weeks mature. Then professional traders, people that been at this for a long time, that's when they want to take some profits. They've made a lot of money. And that's generally when the retail public wants to pile in. And I warned my subscribers a couple of weeks ago. I said, what I thought was going to happen was that gold would probably go above 4,000. And that would bring in the mom and pop people that, have no clue what's going on. They're just hearing on the news that gold is above 4,000. Oh, this is the pot of gold at the end of the rainbow, and we're going to get rich. So let's all run out and buy gold and silver. And then we would probably have to swat those people with a move back below 4,000 to clean out that sentiment. And that would create the fuel for the next leg up, which I think pretty sure will take us up to 5,000 and probably 6,000 by the end of next year.
I think your point about silver is even more interesting in the context with it hitting the twice hit all-time high of about $50. So not only was it late stage in the cycle that you're talking about, but it was also hitting the last major resistance level, which would prove to be a battleground between the bulls and the bears.
Yeah. I think a lot of people were under the impression that a breakout above those all-time highs meant that it was off to the moon. And I would have been in that camp if we could have done that breakout, say 5 or 6 weeks into an intermediate cycle. But I think it was 27 weeks on silver. Don't quote me on that, but it's close enough, somewhere around there, 25, 27 weeks, something like that. So when a breakout comes that late into a rally that's been going that long, I don't really expect it's going to produce sustained move. So I was pretty wary of that breakout, and I warned people on Twitter to be aware that any move that takes that back down to below 50 probably means that was a bull trap, a false breakout, and we're going to have to consolidate and then try again.
Yeah. Okay, so Gary, I know we're going to go to the charts in a bit, and we are going to look at silver and get your expectations there. But before we do, last time I had you on was February, and during that last interview, you had rightly said that silver would reach 40. You had said it would reach 40 in April, no problem. Many people vilified you for that call, saying there's no way silver's going to ever hit 40. That's a pipe dream. You probably remember all the comments that you got there. Mm-hmm. Now, it took 5 months longer until September to reach 40, but it did reach 40, and then it reached 50 several times. And there's been a battle at this 50 level that's been ongoing for a couple of weeks now. It got over 50, it went under 50, it went over 50, it's now back under 50. And maybe it's going to stay under 50 for a period of time, like you're suggesting. But this is a multi-part question. Looking back, why do you suppose it took 5 months longer to hit the 40 mark? Do you expect it to successfully clear the 50 hurdle permanently at some point? And is there another level that you're now expecting and looking out at?
So to answer the first question, I think it took a little bit longer to hit 40 and then get to 50 because we had the tariff scare, which created a lot of selling pressure from the stock market, and that bled over into the silver market. Not so much into the gold market, but it did bleed over into the silver market and the miners to some extent. So when you get a big, ugly sell-off like that in stocks, and you'll get those last, I call it the bloodbath phase, where it's just 5 to 7 days of just selling, and you're starting to get margin calls, and then they just dump everything. Silver got dumped during that, and that set it back. And I think that's why it took a little bit longer than I anticipated for it to get there, but it did get there.
Yes, it did.
And it actually went further than I expected. I really didn't expect it to get all the way to 50 during this intermediate cycle, but but it has. It
It
actually,
actually went through 40 very strongly.
yeah, it went to it pretty strongly, and then even went above 50. So that's the answer to your first question, is why I think it took a little longer. It was just we had that big sell off in the stock market, and the selling pressure infected silver. What was the other part of your question?
Yeah, the second part of the question was, we've seen this battle at the 50 level for a couple of weeks now, over, under, over, under. Are you expecting it to permanently secure over 50 at some point here? And then I guess for not for a long term, but for an intermediate term, are you looking at another level? You were looking at 40 the last time we spoke. I think today it's at 47-ish right now after the bloodbath today. Are you looking at, after you get through this consolidation phase, are you looking at another number north of 50, or where are you at there?
Okay, so um, yes, I think the next intermediate cycle, the advancing phase of the next intermediate cycle, we got to get through this declining phase first. That'll
Right.
reset sentiment. That'll build the fuel for the next rally. But I think that next intermediate rally will clear 50 and we'll hold it. We won't go back below that for probably years. Um, I think I think that next intermediate rally is probably going to get us to at least 75, and it might get us to 100. Um, that will probably top in mid to late spring. And then we'll be due for another one of these intermediate corrections.
Can I,
And then I think
before
by
you
the
move
end of
on,
the year, we're for sure going to get to $100 in silver.
by the end of 26?
Yeah,
Okay.
for sure. We might
So,
get there earlier. We might get there in the spring, but I think for sure by the end of 26 we will.
so 75 by spring or end of spring-ish.
Mm-hmm.
So I don't know if you've, heard this, paid attention to this, or even care about this, but you may know former Fed um, nominee Judy Shelton has talked about next summer, July 4th, being the 250th anniversary for the United States of America, and that there would be some kind of coming out gold-backed bonds or something to this effect. I don't know that there's been any real clarity over what specifically they would be doing, but they would do something with that regards. Do you think that there would be some type of strength in the metals going into that period of time?
Yeah, I haven't heard anything about it. I don't
Okay.
really kind of follow that stuff,
Okay.
technical rather than fundamental. I know the fundamentals are driving the entire bull market, but I'm kind of trying to trade
Yeah.
the intermediate cycles, and that's based on sentiment, not fundamentals. So I
I
don't.
appreciate that. Yeah, no, I thought I would ask. Okay, so since gold broke out over 2000 last March and begun its bull cycle, there's been a few periods here where you could see in the charts the cycle advance halted, it paused, it consolidated along the way, with each period ranging, a 6 to 10% decline roughly, and consolidation for whatever period of time before resuming its march higher. The last time was what, April to
April to August, I think.
April to August, yeah. So timeframes lagged from few weeks to few months for each one of these.
Mhm.
10% from the top would be about $400. So that would take us down to that $4,000 level. If we had a similar type drop, 6 to 10%.
Mhm.
Do you expect this zone of 4,000 to 4,400 gold, where it's become more volatile, to be the approximate consolidation? Maybe not exactly, but
I think it's
approximate.
I
Or
think it's
are
going
you
to break it.
expecting something bigger?
I think it's going to break it. As I said, the 4,000 was the number that caught the attention of the public, and that's where they all started piling in. And you're seeing the lines at the bullion shops and such.
Yeah.
I think you got to go below 4,000 to knock those people out. Um, and the last four, I think, intermediate corrections have been, as you said, they've been more of a sideways churn that kind of eats up time and allows the 200-day moving average some time to catch up to price. Um, the last four have unfolded like that. I don't know that this one's going to do that. This particular rally has gone so far, and we can pull up a chart here in a minute and I'll show you. It's gone so far above those moving averages that in order for, if price was to just churn sideways like it did the last four times, it would take 8 to 10, maybe 12 months for that moving average to catch up to price. And I don't think we have enough time in the 8-year cycle. We're still in the advancing phase of the 8-year cycle. I don't think we have enough time to waste 10 or 12 months on a sideways churn for the moving average to catch up. So I'm of the opinion that this correction's probably going to be more of like one of those scary ABC moves where you'll get, and today we saw, a big, I think 6% drop in gold. That's pretty unusual. I think
It was a once in 63-year move is what I had read.
We may get a little bounce here because I think we closed below the lower Bollinger Band. That's usually good for some kind of a little bounce, but I think this is the A wave. I think it's got further to go. And then usually what happens is when you're in the scary type of correction, as opposed to the long consolidation, the scary correction builds fear. The consolidation correction builds frustration. Either one of them can create the fuel for the next rally. But I think we're going to be in a scary correction. And at some point, we'll get the buyers will try to buy the dip, and you'll get that B wave bounce. And it's a fake out bounce that generally doesn't make higher highs. And then it'll roll over and you'll get a lower low, and all those people that bought a little bit prematurely will get knocked out at the bottom. And then that's the point where you run out of sellers. There's nobody left to sell. The fundamentals will resume and take over again. And then you'll transition into the advancing phase of the next intermediate cycle. And as is always the case, by the time you get to that bottom, everybody that was, ultra bullish and couldn't see any possible way that price could go down, there's a shortage of silver or central banks are buying gold, and this is the reason why price can't correct. That narrative will have disappeared. And now the narrative will be, the war cycle is ended and the dollar is rallying, and that's why gold can't ever go back up. And that's when you need to buy, because the fundamentals really have not changed. All we've done is we've had a correction that has cleared that bullish sentiment, built the fuel for the next leg up. So, if you talk to me 2 months from now, the narrative will have changed, and everybody will be negative, and that's when I'll be trying to get people to buy. And as I always say, I can't get people to pull the trigger at bottoms, and I can't get them to sell at tops.
So that was going to be my follow-up question. And you could pull up your first chart if you'd like while I'm asking this, and that would be the gold chart. But when you have this scary ABC drop, like you just described, versus the long sideways chop that we had back from April to August, what is the expected time frame on that? I would assume it's more compressed.
It is, yeah. So like right here, this actually all of these are examples of a frustration corrective move, an ICL that forms as a sideways churn that creates frustration rather than fear. At some point, people just get frustrated. It's just not moving. They give up and they go looking for something else, whether it be uranium or bonds or stocks or whatever. And then what happens is, about the time everybody gives up, then we start to rally, and they're stuck over in some other trade. And so by the time they're ready to jump in, half the rally's gone by. And those latecomers, that's the fuel for the next move up. And that's what all of these have been: sideways churn, sideways churn, sideways. This was actually a triangle, and then a 4-month sideways churn. But this, you can see, this has been very unusual, which is, it's very aggressive. It's almost parabolic. Parabolic moves, they usually go down about as fast as they go up. And that's what makes me think that we're probably going to have, and you can see here, this this is just stretched prices obscenely far above this 200-day moving average. It's obscenely far above the 50-day moving average. So
Yeah.
I think what's going to happen is we'll probably, maybe this A wave will come all the way down to the 50-day moving average. And of course, the 50-day will move up every day a little bit. It'll may come down and tag that 50-day bounce. Everybody will think that that's the bottom. And then we'll have another leg down that makes a lower low that it doesn't have to get all the way back to the 200-day moving average. But I think we got to shrink a lot of this stretch between price where it was here and this 200-day moving average, and that will clear the sentiment. It will create fear. People will, start to question whether the bull market is still in progress. We're still.
I think they already are, to be honest with you. I saw a lot of that today.
Yeah, this was scary for sure. I think it'll knock out those mom and pop people that are buying gold and silver right now. And then I think that sets the stage for silver to 75, gold to 5,000 or 6,000. And by the end of the year, I'm pretty confident in calling $100 silver by the end of 26.
So you're thinking 5 to 6,000 gold and 100 silver the end of next year?
By the end of next year. It might occur quicker than that, because I'm pretty sure right here when we, this is kind of when I made the call that this was where the cartel suppression of gold broke here, when they couldn't drive it back below $2,000, and then you can see what happened. It just the short squeeze just started, and it's just been going, and it was really in effect here. I think this is the initial phase, and I think we're still somewhat early in this initial phase, but I think we're kicking off the bubble phase in gold. And generally what happens is when the general public starts to take notice, you got about a year to a year and a half. I think the general public started to take notice right here when we went above 4,000. So once we finish this correction, I'm going to say we've got a year and a half at tops, maybe 2 years. And then I think we'll probably have the top of this bull market. And I think we're going to get to at least 10,000.
Okay, so before you either move on or share something else from this chart, right where you are in that line, if you go straight up into that zone there, yeah. So from the end of March, we have a topping point right there. And then it came down in what to me would be described as a scary drop through the beginning of April and went slightly below the 50-day moving average.
So that is an intermediate degree correction, but it didn't really meet the normal parameters for an intermediate correction. And when I say that, generally what needs to happen, it needs to break the intermediate uptrend line. I'm not sure what I've got on here. 1 second.
Yeah, sure.
I got my Fibonacci tool, sorry. Anyway, the intermediate upturn line, you draw it from this point to this point, and I think all we did was tag it. Generally, in a scary correction, the scary type correction, you'll break that trend line. Usually you'll break it by a lot, close quite a bit below it. Also, it usually goes deep enough and lasts long enough to turn this 50-day moving average back down. And you can see it did turn it down during this triangle here, kind of flattened it during this one, flattened it during that one. During this one, if it's going to be one of those scary type corrections, I think price is probably going to go below this and hold, and either go far enough below it or hold below it long enough to roll this 50-day moving average over to where it's at least somewhat moving lower. Those are the normal parameters for the quote unquote scary type correction, the ABC correction. I think that's probably what's going to happen, just because we've gotten so stretched above the 200-day moving average here. And I
So
think
that end of May, I'm sorry, the end of March top comes down and then goes back up and then comes back down to tag 50.
ABC.
That's considered an ABC as well.
It did meet that parameter. It did meet the ABC parameter, but it didn't drop far enough. I don't I'm not even sure this made it back to the 38% Fibonacci retracement from this
Are you
last.
able to tell what the drop total is from the high at the end of March to that? Yeah, from there to that.
So that was just a little above 3,500, and it went down to almost 3,100. So let's just call it rounded and say it's about 400 points.
So 435. So that's more than 10%.
Yeah.
Okay.
This one is likely to be bigger just because the
Okay.
stretch is bigger.
Yeah, the stretch is definitely bigger. Okay. So last question on this, unless you have anything else you want to add, and that is, I thought I just heard you say a moment ago, a year and a half to 2 years after we uh, get through this declining phase,
Yeah.
start the next advancing phase,
Mhm.
and it will be during that 1.5 years post that you expect to hit 10,000.
Mhm. That's about how long it takes for the general public, for everybody, every last buyer to pile in, and then that's the point where there's just nobody left to buy. And usually that's the point where the asset is just obscenely overvalued. And I would expect at that top, wherever it comes, whether it be 10,000 or 15,000 or whatever, gold is going to be obscenely overvalued, and the dollar will be obscenely undervalued. You're going to need to trade your gold and silver for dollars. All markets follow this pattern. They go from overvaluation to undervaluation, and your job as an investor and a trader is to try and recognize when something is extremely overvalued, and then move your wealth or your capital into something that's extremely undervalued. And I'm pretty sure that's what's going to, when gold is extremely overvalued, I think the dollar is going to be extremely undervalued. So you're going to want to trade your gold and silver in for dollars.
All right. So this will all happen within this current presidential term and top out in your analysis before Trump leaves office.
Probably.
That's the likelihood that you're seeing.
In my opinion, I think this 8-year cycle is where gold is going to reach its bubble top. And remember, this bull market started back in, what was it, 21? I guess it was a double bottom in 99 and 21. So this bull market, in reality, I mean, we had a cyclical bear market for a few years, but the secular bull market has been in effect since, take your pick, either 99 or 2001. So this is a 26-year bull market. It's very mature. And the fact that the angle of ascent has just gone radically parabolic here is telling me that we're getting into the final stages of this bull market, probably. I may be wrong. Maybe it'll be another 8-year cycle before we get to the top. But well, I'll put it this way: if the gold silver ratio gets down to 30-1, somewhere between 20-1 and 30-1, 30 ounces of silver to 1 ounce of gold,
Mm-hmm.
at a top here in, say, a year and a half, that's the end of the bull market.
So is that your expectation, is that we're going to see the gold to silver ratio go from low 80s, which it is today, at the end of this cycle,
Mhm.
when it's 10 to 15,000 gold, down to 20 to 30 to 1 gold to silver ratio? Is that what you're expecting the end to look like?
Yeah, that's probably the key marker that I will be looking for. That's the bell ringing that I need to start selling my gold and silver.
Okay.
That was I think it was, I'm not sure if it got to 30-1, but I know it got to at least 35-1 at that 2011 top.
It was 32 to 1 there, and it was 15 to 1 in the 70s, 79, 80.
Yeah. So That was a cyclical bull market top, followed by a cyclical bear market. We got to 32 to 1. I think we're probably going to get to somewhere between 20 to 1 and 30 to 1 at the final secular bull market top, which at that point will be, 28, 29 years mature. And that's a pretty long bull market. So, when we see that gold is silver ratio at 20 or 30 to 1, that's overvalued. The metals are extremely overvalued. It's time to sell those and start looking for something else.
Okay. All right. Well, let's move over to the gold miners chart if you're okay with that.
Okay. I'm going to use GDXs.
That's fine.
And so you can see the same problem here, just stretched obscenely far. And, compared to, these peaks here were stretched a long ways above the 200-day moving average. This peak was stretched a long ways. Now you look at this. This is, somewhat ridiculous how far this is above this, and that's why we have this big, huge sell-off. And the reason these things, when they go straight up, they also go straight down, is because you have a lot of, let's say, retail traders, unsophisticated traders that are buying during this parabolic move up. And so when you start to sell off, you start hitting stops on all these people that bought into this parabolic structure, and that tends to exacerbate the selling. So the general mentality for, like, a retail type trader, maybe somebody that doesn't have a lot of experience, is that when they see something like this, they assume that this is extremely bullish. And it would be if we were maybe a year into the bubble phase, it would be extremely bullish, but I don't think we're in that final bubble phase yet. So this is, in my opinion, this is more bearish because there's just stops to get hit all along this parabolic structure. And very often these kind of moves will retrace all the way to the beginning of where the parabolic move started from, which would have been back here at 55. I don't know that it's going to get all the way down to 55, but I'm pretty sure that we're going to shrink a lot of this white space between price where it is even still today. After today's sell-off, we still got a long ways to go to get back down at least somewhat close to this 200-day moving average. So I think we got a lot more downside to go, and probably my guess is that it may take us into December before it's time to buy. And so, a lot of people, because they're very bullish because of this, they want to buy quickly because they're worried that that's going to resume and they don't want to miss the next leg up. Whereas it usually just takes some time to work this off. It can get worked off with a really scary crash, but I think we're probably going to have, I think we're in the process of the A wave down. I think we're going to have that fake out B wave bounce. And then I think we'll probably have a C wave down that'll take us much closer to this 200-day moving average. And that takes a little bit of time to play out. So I'm going to guess maybe sometime in late November, or even as late as mid to late December before this correction is done. So I think you just got to be a little patient here. Be wary of that initial B wave bounce. It's probably going to be a fake out, and then wait for a lower low. And then when everybody's bearish again, that's when it's time to buy, because the fundamentals will not have changed.
Okay. All right. Let's take a look at silver and have a look at that chart.
Same problem with silver, just stretched really far above the 200-day moving average. And if I expanded this chart, you'd see this line here is that $50 that was the high in 1980, and then again that high in 2011, I think it was. You can see the breakout, and then this is what I warn people: if we get a breakout that doesn't hold, that's probably going to be a bull trap that catches late people that are FOMOing in, thinking that this breakout is going to produce a move to 60, 70, pick your number. The problem is that here's our intermediate cycle low, and look how many weeks we had getting to that breakout. It's too late in that intermediate cycle. I don't like breakouts that occur that late in the cycle. If our bottom was right here, if that intermediate bottom was right here and the breakout occurred on say week 6, 7, or 8, then I would be very aggressive buying that breakout, because it would potentially have another 10 to 15 weeks to go before I'm looking for that intermediate top. But a breakout that occurs, and I think this is week 27, a breakout that occurs on week 27 of an intermediate rally is too late to really expect a sustained move.
So now, if this was the bubble phase, you had mentioned earlier, 1.5 to 2 years.
Mm-hmm.
So the stretch beyond the 200-day moving average, the parabolic rise, all of that goes out the window in the bubble phase?
Exactly. Goes out the window. The volatility will become much greater. There'll be days where we even had it in the NASDAQ in 2000. I think we had a 3-day period, I believe, in the NASDAQ where it dropped 15%. Could you imagine that now? 15% in the NASDAQ in 3 days. The gold and silver market are much thinner than the NASDAQ. So we're probably going to have periods where we might even have a day where silver could drop 20% in a day. That won't mean that the bubble phase is over. It just means that the volatility is becoming extreme because it's getting late in the bubble phase. So this kind of volatility that we saw today is not unexpected, and it's going to get worse as the bull market matures over the next, say, 1.5, 2 years. So, be prepared for this kind of stuff. Doesn't mean the bull market is dead, but it does mean it's getting mature. And when we get in the bubble phase, the volatility is going to get much worse. Again, it won't mean that the bull market's over, but it does mean that we're, getting deep into the bubble phase. And at some point, you're going to have to control greed and just sell. And I was trying to get people to sell up here, control greed. We've made enough money. I mean, we've been riding this all the way from the beginning of the year. We rode the first phase up. We made a lot of money in the first phase. We kind of twiddled our thumbs for that 4 months between April and August. And then we rode this second phase up. So, we made a lot of money. For heaven's sakes, if you can't be satisfied with a record-breaking year, and you've still got FOMO at this point, then you've got a real problem trying to control greed. And if you think it's hard to control greed right now, right here, it's going to be 10 times as hard to control it at the top of the bubble. And if you don't, you're going to get caught when the bubble collapses. And we saw what happened in 2011. Silver dropped 30% and almost in the blink of an eye. So you cannot get caught at the top of the bubble. So you've got to, at some point, you got to say, hey, I made enough money. I don't care if it keeps going up. I want to make sure I don't get caught when the bubble pops.
That's great advice. Okay, so you could take it off the sharing if you'd like. This has been an incredible discussion, and I appreciate the walk through the charts. I want to welcome everyone who's tuning into this fantastic interview with Gary Savage, founder of the Smart Money Tracker. Before we wrap up with the final set of questions here, I just want to direct everyone who's interested in the metals and mining sector to dive into the Substack, metalsandminers.substack.com. Join our quickly growing community. Receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's also the name of the report. Now, I'm positive that you've been enjoying this conversation that Gary and I have been having. Please let him know. Hit the like and subscribe button and leave a comment below the video. All right. So Gary, before we started recording, I mentioned that we were going to do an asset ranking lightning round. So basically, I'm just going to ask you to rank some assets as of right now, not for the next 5 years or anything, just where you see things right now. Give it a score of 1 to 100, 100 being an extreme buy, 1 being an extreme sell. Just give 1 or 2 sentences as to why you take the position. We'll try to roll through them quick. And if you are not following the asset, that's fine. Okay. All right. So for right now, on a scale of 1 to 100, is gold a buy or a sell, and why? Physical gold.
It would be a sell right now. We've got to get through the declining phase of this intermediate cycle.
Okay, so if you were to give it a score, 1 to 100, what would you put it at?
It'd be 1.
Okay.
I do not want to buy right now.
Okay, gold miners.
Same thing, 1.
All right, physical silver.
Same thing.
Then I'm assuming silver miners, same thing.
Yeah, yeah, they're
Okay.
they're all going to follow gold. They're
Okay.
not going to disconnect from gold. If gold's going down, everything's the whole metal sector is going to go down.
Okay. Let's move over to copper. 1 to 100 and why?
I don't particularly follow copper, but I suspect that it's probably going to be drifting down also.
Okay. Do you follow energy, uranium?
Um, the rally is very mature. I would say I wouldn't give it a one, but I certainly wouldn't give it 100 at this point. I'm a bit ambivalent on uranium. Long term, I'm very constructive on it, but the rally's just really mature, and it looks like it may be ready for a correction as well.
Would you put it at 50 or below 50?
Probably below 50, maybe 30.
30. Okay. Oil.
Um, it's still a one. I think we got a little bit further to go on this intermediate decline. We may have to retest those lows from whenever it was, February or May, or don't remember when. But um, and if we break those lows, we might even go into the 40s. So I think we've got a little bit more downside in oil yet. So I'm not ready to buy oil just yet.
Okay. The NASDAQ.
Um, Probably a 10 or a 20. Again, very mature rally. I think we might get a marginal breakout on the S&P that'll get everybody bullish. I think the big money's going to sell into that breakout. I think we've got maybe a mini excuse me, mini
Bless you.
crash in the stock market here that might have to come down and test those was it the April high? We might have to test that pivot at the April high yet before we need to clear sentiment in this market as well, and before we can have another leg up. So I'm not buying into this, not this late.
Okay. So you feel the same about the S&P, 10 to 20 on that?
Yeah,
Yeah. All right. Let's move over to short-term treasuries.
not my thing. I don't
Okay.
follow.
Um, and then I'm assuming long-term treasuries you don't as well.
No.
Okay. On a scale of 1 to 10, each representing a percentage, where do you see inflation ending the first quarter of next year, 2026? So over the next, say 5 months.
Well, I think the Fed's probably going to reignite inflation with these interest rate cuts. Kind of the same thing happened in the 70s. They started cutting a little too soon, and inflation came back. I think the same thing is likely to happen, and I don't think we're going to be able. I mean, Trump's done one heck of a job with the wars, stopping some of them, but I don't think he's going to be able to stop the war cycle completely. I think it's going to reignite. Not even sure he's going to be able to even temporarily stop the um, war cycle in Europe, and that's inflationary. So he's on the right path with the energy and the drilling, and because energy is the main component driving inflation. When the price of energy goes up, that's inflationary. Everything, the price of everything goes up. That's what causes recessions. When oil rallies 100% or more in a year or less, it's a massive shock to the middle class and the lower class. They stop spending, and that starts the rock rolling down the hill. We start to spiral down. So he's on the right path um, with the drilling and trying to increase energy, and that's probably one of the reasons oil has been struggling. Has been in a bear market for months now, but I don't think he's going to be able to stop the war cycle completely. I think it'll come back, and I think the premature cuts on the interest rates will probably reignite the
So if you
inflation.
had to give us a number, would you say that we'll see by the end of first quarter 26, do you see inflation maybe reigniting past 4%, 5%?
I would put it more towards the end of the year, but yeah,
Okay, so the end of 26, when you see gold between, did you say 5 and 6 or 6 and 7?
I think we're going to get. I think gold will probably get to 6,000 by the end of 26.
Okay, so 6,000 for gold, 100 for silver, and
I think
4%,
oil. I think oil
4%.
will have bottom by that time and be starting back up, and I think we'll be at least at 4%. We might be even as high as 5 or 6.
Interesting for inflation. So by the end of fourth quarter of next year, you see inflation becoming a headline. in news stories again.
Yeah, I think
Yeah.
so.
Okay. So you mentioned recession in your answer, and that probably recession has been avoided because of low energy costs, because energy is involved in everything. Um, if we had to put a probability 1 to 10, 10 being the highest, recession by the end of first quarter of 26 or halfway through the year, what would you put it at?
Very unlikely during the beginning of the year, unless um, Europe starts World War III. If and I think that's going to be what causes a recession ultimately anyway. Is Europe just seems intent on starting World War III, and they're probably going to get their way, and then that could be something that could start the recession, other than a spike in energy, although that will probably cause a spike in energy as well.
And it might come from France. I mean, France, they made this pronouncement to their hospitals to prepare for mass casualties by the end of the first quarter. And then suddenly, in the last couple of days, I guess there was some type of attack. Who knows if it was a false flag or not, but they found a Russian passport.
Yeah, I didn't see that story, but I'm pretty sure there's going to be some kind of false flag to give NATO an excuse to go into Ukraine. They want a war, and
I really hope we could
they'll
avoid that.
probably get it.
Yeah, I kind of agree with you on what seems to be going down, but I'm hopeful still that it
Yeah,
can be avoided.
I mean, I'm encouraged that Trump is making some progress on the war cycle, but I don't think he's ultimately going to be able to defeat the war cycle. But he may abort it for a bit.
Yeah. So finally, in this area, and I know you're unconventional when it comes to traditional investing, but it's been 60/40 portfolio recommendation allocations for decades. 60% stocks, 40% bonds. That's been the portfolio allocation. And quite frankly, there's been no room for physical gold.
Mhm.
Now, we have seen Morgan Stanley come out in the last couple of weeks saying, 20% gold allocations in lieu of 20% bonds. But do you have a perspective on gold ownership, physical gold ownership in as a percentage of one's portfolio of what they own? Should they own a certain amount or even have some at all?
Um, well, gold is in a bull market, obviously. Hasn't, although it may be starting, it hasn't reached the parabolic bubble phase yet. So, as long as it remains in a bull market, I don't know why you wouldn't want to just be in gold. You got a once in a lifetime bull market that's approaching the final stage, and the most money in any bull market is made at the very beginning of the bull market and at the very end of the bull market. So personally, I don't really want to be in stocks right now that I I'm afraid that the war cycle at some point is going to escalate, and we're going to have at least a cyclical bear market in stocks. I don't think the long-term bull market in stocks is over. AI is still somewhat in its infancy. Um, and besides that, the bull market's pretty short compared to the other two. And magnitude wise, also very short. The last two secular bull markets added like 20 times or 25 times on the Dow. I think the last time I looked, the S&P was like only at 9 times. So I think we've got further to go, but I think we might have a cyclical, like we may have a recession and a cyclical bear market in stocks. So I'm not I'm not interested in that 60% in stocks, not right now. I have no interest in bonds, period, because we're in a secular bear market for bonds. So, if you wanted to stick with the 60/40, then I would go 60% gold and 40% stocks at this point. And personally, I would not go stocks because I think we're probably going to have a cyclical bear market here soon because of the war cycle.
Okay, I appreciate that. Gary, would you share a key takeaway that you want viewers to keep in mind about anything going on today that's top of mind for you, and then let everybody know where they can learn more about your work, how they can connect with you, etc.
Well, I think the most important thing right now, because I think a lot of things are gonna either have, metals have, I think. Stocks probably are about to. Oil is. They're all either in or getting ready to start the declining phase of the intermediate cycle. That just takes some time. Usually 4 weeks is like minimum, and generally it'll take 6 to 10 weeks for these intermediate declines to run their course, unless it's some kind of a crash event. If it's a big crash event, something that takes price back down to the 200-day moving average quickly, it can be over quick. I don't anticipate that though. So right now, I think it's a good time to just build cash, take profits on, on your metals. Be happy. We've had one hell of a run. Be happy with that. Take profits on your metals, raise some cash, and then be ready. And when when the sentiment becomes dark again and everybody is just, under the impression that the bull market has ended, that's when you want to be buying again, because the fundamentals have not changed and the bull market is not over. At the moment, the S&T is still closed to new membership. I only do yearly memberships now. I want you to give me a year. If you give me a year, I'm almost solely focused on the metals, and all I do in the S&T is we try to trade those two intermediate cycle lows every year. So about twice a year, things you either get really frustrated or you get really scared. I try to buy those, and then we ride the advancing phase of the intermediate cycle. There's generally 2 of those a year. That's what we did this year, and we made record profits. If you give me a year, I'll make you a lot of money, because the bull market in gold and silver is still in effect. It's not over, and it's not going to be over for at least another year, probably 2 years. I will reopen the S&T in December, and I'll put a notice on my Twitter feed when it's open and ready for new subscribers to join if they want to. But you're going to need to be focused basically on metals. When we get into these intermediate declines, I don't go searching for something else to trade. I don't trade uranium or stocks or anything. We just twiddle our thumbs. So if you don't have patience, S&T is not going to be a place for you. You're going to have to be patient and wait for the proper setups. You also have to be able to control greed when we get like we did in metals here, where we've just gone up far enough, we've made enough money. You've got to be able to control greed and take profits. You can't stay leveraged forever, because at some point you're going to have that intermediate correction. If you're leveraged into that, you'll lose everything.
And can you give the address for your Twitter and for your website?
So my Twitter is Gary Savage 1, small g. Of course, everybody has these scams on there. People, if it doesn't say Gary Savage 1, it's not me. But I do post stuff from time to time. I've been posting quite a bit the last week, trying to get people to take profits on their metals. And then the website is smartmoneytrackerpremium.com.
Okay, wonderful. Gary, thank you for coming on to Metals and Miners again, and for being so generous with your time, analysis, and ideas. It's always wonderful to spend the time with you. I look forward to having you back on sometime soon. And everybody else, thanks for watching.
Thanks for the invite, Gary.
Before we wrap up with the final set of questions here, I just want to direct everyone who's interested in the metals and mining sector to dive into the Substack, metalsandminers.substack.com. Join our quickly growing community. Receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's also the name of the report.